Welcome to this deep dive, designed specifically for you, the learner. If you're looking to get a solid handle on important topics quickly without getting too overwhelmed, you're in the right place.
That's right. And today we're tackling something really crucial in the real estate world: risk management, and just as importantly, exit strategies.
We've got some great material to draw from. An article from the Baldwin Group, Real Estate Risk Management, Strategies to Protect Investment, and also a really insightful YouTube video from Jesse Vasquez called Top Real Estate Exit Strategies You Need to Know.
Yeah, both excellent sources. Our mission here is basically to pull out the most important nuggets from these, giving you a kind of shortcut to understanding how to navigate real estate risks and why planning your exit is so critical.
We'll look at risk mitigation from different angles, owners, managers, investors, and then we'll pivot to those practical exit strategies, hopefully providing some real actionable insights, maybe a few of those aha moments.
Definitely aiming for those.
But before we dive in, we really want to give a shout out to our sponsors. They understand the diverse needs within our community. First, Flowers and Associates Property Rentals. They specialize in special needs housing, which is just fantastic work.
Absolutely. You can reach them at 901-445-8148 or check out their website, flowersandassociatesbooking.com.
And many of you might remember we spoke with Robert Flowers, the founder, in a previous discussion. We got such wonderful feedback about that conversation.
He's doing great things. We also want to mention Graceful Journeys Transportation. Founded by Angela Kraft, they're dedicated to transporting seniors and individuals with special needs. Really vital services.
Truly vital. Okay, so let's get into it. Real estate risk management. The Baldwin Group article really emphasizes how, competitive the market is.
It really is.
Yeah.
And because of that, being proactive about risk isn't just like a nice to have, it's essential. Doesn't matter if you're an owner, a manager, investor, lender, everyone needs a plan.
And the risks aren't static, are they? They shift depending on the market, regulations.
Exactly. What's interesting is how the article breaks it down by role. Let's start with real estate agents and brokers. People often use those terms interchangeably.
Right, but brokers usually have more oversight, more liability.
Correct. And their key risks, often legal and ethical stuff. Misrepresentation is a big one. Fraud, breach of contract, confidentiality.
Things that can lead to serious trouble. And then there are client disputes, right? Over commissions. Maybe the property condition wasn't what was expected.
Yep, all that. Plus, they're exposed to market fluctuations, just like everyone else. Economic downturns, interest rate hikes. It's important, too, to distinguish them from insurance agents or brokers. Different focus entirely.
Good point. Okay, what about property managers and owners? Their world looks a bit different.
It does. They're often thinking about, financial fallout, property damage, maybe tenants defaulting on rent, market shifts hitting their income.
And litigation risks must be huge. Landlord-tenant disputes, maybe labor law issues if they have employees, not keeping up with regulations.
For sure. And just the operational side, keeping the place maintained, dealing with major issues like a fire or flood, and increasingly cybersecurity. If their portfolio changes, their whole risk picture shifts. They need the right insurance limits, for instance.
So due diligence is key for them. Now, investors, they seem to juggle even more complex risks.
I think so. They're looking at financial risks, obviously property values going up or down, rental income changing, broader economic trends. Then there's the legal side, contract issues, tax liabilities changing, new regulations popping up. The Baldwin Group also points out how lenders' insurance requirements are a big factor.
Oh, interesting. So the lender might dictate certain insurance needs.
Absolutely. And insurance providers themselves are getting stricter, demanding proof of risk mitigation before they'll even offer coverage, like, specific flood defenses in flood zones.
Right, okay. That makes sense.
And don't forget, liquidity for investors. Selling real estate isn't like selling stock. It takes time, thorough due diligence. Even the insurance market's mood can affect a deal.
Yeah.
Investors need to know their property's true replacement cost and its loss history cold.
That leads nicely into property-specific risks. Natural disasters are the obvious one.
Yeah, and very location-dependent, of course.
Yeah.
The article mentions something important: catastrophe aggregations. That's how insurers track their total potential payout if one big event hits an area where they have lots of policies.
Ah, okay, so they don't want too much exposure in one place.
Exactly. Lenders worry about this, too. Having prevention plans for floods, windstorms, whatever's relevant is crucial.
But it's not just the huge events, is it? The article talks about basic maintenance and upkeep.
So important. It protects the investment long-term And, like we said, can actually make insurers happier, maybe lower premiums. And then there's aging infrastructure.
Oh, yeah. Old plumbing, dodgy wiring,
Yeah,
big potential costs and safety issues there.
definitely. And these property issues often tie into the wider economic picture.
Like interest rates affecting affordability and values.
Precisely. Or shifts in tenant demand, changing occupancy levels, difficulty getting financing, even just keeping up with competitors and what tenants expect nowadays.
It's a lot to track. And then the article mentions operational and regulatory risks.
Right. Good property management is key, keeping tenants happy, reducing liability through proper maintenance, and compliance.
Wow.
Zoning laws, tenant protection laws, habitability standards, local, state, federal. It's complex.
And safety and liability on the property itself, preventing accidents, having good security, it all ties back to minimizing risk.
It really does. So the big question for our learner is, okay, there are all these risks. How do you actually start managing them?
Good question. The Baldwin Group suggests a 3-step process, right?
Yes.
Yeah.
Step 1, conduct a thorough risk assessment. And this isn't just one person's job. You need everyone involved, owners, lenders, managers, investors, tenants, even IT because of cyber risks.
So looking at everything, physical risks, liability, financial, cyber, regulatory.
Exactly. Climate risks, structural issues, maintenance backlog, cyber hygiene, financial health. Get it all on the table.
Okay, then step 2.
Identify the specific potential hazards that could trigger those risks. Again, collaboration is key. What are the specific climate threats, structural weak points, maintenance gaps, cybersecurity vulnerabilities, financial instabilities, on-site safety issues? Get granular.
Got it. Assess the broad risks, then identify the specific hazards, and step 3.
Evaluate probability and impact. How likely is each hazard to happen, and how bad would it be if it did?
Okay, so how do you figure that out?
You look at historical data, you talk to experts, you understand your obligations to third parties, and you consider your own company's risk appetite. How much risk are you willing to take?
And the goal is to link these risks to actual outcomes.
Yeah.
Financial losses, legal problems, reputation damage.
Precisely. That helps you prioritize. You can't fix everything at once, so you focus on the biggest threats first.
Makes sense. So once you've done the assessment, identified hazards, evaluated them, what practical strategies can you use? Baldwin Group lists 5 essentials.
Right. Number 1, comprehensive safety plans for all sorts of scenarios, weather, other crises. And the key is these plans need to be ready before something happens, not figured out during the event.
Proactive, not reactive. Okay, number 2.
Review your contracts meticulously. Purchase agreements, leases, management contracts. Get your legal and risk teams involved.
Looking for what specifically?
Legal soundness, making sure your rights are protected, and that the contract addresses potential risks, disputes, liabilities, financial obligations. Strong insurance clauses and clear risk transfer language are vital here.
Gotcha. Strategy 3.
Transparency and communication. Be honest and accurate with clients. Respond promptly. And keep your insurance folks, risk managers, property managers in the loop about property conditions, loss history, any hazards you know about.
Open lines of communication, build trust. Makes sense. Number 4.
Stay updated on market conditions and trends. Keep an eye on interest rates, economic news, what's happening locally. This helps you anticipate risks and adjust your strategies.
Staying informed to stay ahead.
Yeah.
And the 5th one.
Protect your employees. Workers' compensation insurance. It's a legal requirement in most places. It's the ethical thing to do, and it reduces your financial risk if someone gets hurt or sick on the job.
So safety plans, contract reviews, communication, market awareness, and employee protection. Seems like a solid foundation.
It is. But remember, risk management isn't a one-time thing. It's ongoing. You have to keep adapting.
Absolutely. Okay, let's shift gears now and bring in Jesse Vasquez's insights on exit strategies. He really kicks things off by stressing how important these are, especially now.
Yeah, he points to all the regulatory changes happening, particularly with short-term rentals, Dallas, New York, California. You name it. His point is you need an exit plan from day one, or you could face serious financial trouble down the line.
He draws a parallel to managing risk in stocks or bonds, doesn't he?
He does. Smart investors always think about the what-ifs, the potential downsides, like planning for something unexpected, like COVID was. Intuitive investors do this.
And for Vasquez, it's not just about avoiding loss, it's also about maximizing profit by being adaptable, right?
Exactly. He shares his own story about pivoting to midterm rentals when the short-term market took a hit in 2020. It shows the power of having alternatives ready to go.
That really speaks to not putting all your eggs in one basket. So what are some common exit strategies he discusses?
Well, short-term rentals are one, obviously. High income potential, sure, but very vulnerable to those regulations and market swings we talked about. You need a plan B.
Which leads him to midterm rentals.
Yes, he's a big advocate.
Yeah.
Rentals from, say, 1 to 6 months, often for corporate clients, traveling nurses, people like that. He sees it as a great hedge against short-term rental rules. He used it successfully himself in Modesto, California.
What are the advantages he sees?
More stable income, potentially. Less tenant turnover than short-term lets, which means less wear and tear, fewer cleaning fees, less hassle generally.
But it's not passive, is it?
No, definitely not. He stresses you have to actively market these. Reach out to companies, relocation agencies, healthcare staffing agencies. You can't just list it on Airbnb and expect the right clients to find it.
Okay. What else does he suggest? Renting by the room?
Yeah, that's another option if short-term gets restricted. You could rent individual rooms, maybe to travel nurses again. But he warns it's management intensive, lots of turnover, finding individual tenants. It's work.
Right. Then he talks about something called pad split.
Yes, this is interesting. It's a co-living platform. They help convert single-family homes into shared living spaces, aiming for affordability.
Co-living. So multiple people sharing a house, essentially.
Exactly. He thinks it has huge potential, maybe even doubling income in some areas, while also helping with the affordable housing crunch. And Pad Split handles finding tenants and some management tasks. He mentioned a 97% rent collection rate, which is impressive.
Wow. And he mentioned Mark Cuban invested.
He did. Sees it as a sign of the model's viability. The main takeaway from Vasquez, really, is think about your exit before you buy. Have multiple options in mind. Don't just focus on one type of rental or one strategy.
Diversify your thinking, essentially.
Precisely. And he encourages listeners to share their own experiences too, which is great. Learning from each other.
Absolutely. Well, hopefully this deep dive has given you, the learner, some really valuable insights into both real estate risk management and the absolute necessity of having solid ALIT strategies.
Yeah, from understanding those unique risks faced by different people, owners, agents, investors, to looking at practical ways to lessen those risks and planning ahead with things like midterm rentals or co-living. The goal was really to boil down this complex stuff into usable knowledge.
Remember those 5 key strategies from the Baldwin Group: safety plans, contract reviews, transparency, market awareness, and protecting employees.
And think about those exit strategies from Jesse Vasquez, especially how relevant midterm rentals are becoming, and these newer models like Pad Split.
It really highlights that in real estate, being proactive, planning ahead, and having a multifaceted approach, that's how you protect your investments and find new opportunities.
Couldn't agree more. It's a dynamic field.
So as you continue your learning journey, here's something to think about. What unexpected market shift, or maybe a regulatory change, could most impact your own real estate plans, whether current or future? And thinking about that, what's one small step you could take today to start building a more resilient strategy?
That's a great question to mull over, something to keep exploring in this fascinating field.